Two engineers are sitting in the same video call. Same company, same title, same salary, $180,000 a year. One is paying rent on a 2-bedroom in San Francisco. The other just bought a house in Boise. By the time they both retire, the Boise engineer will have accumulated roughly twice the net worth. Not because she earned more, not because she invested better, but because she understood something the other one didn't. The game isn't just about how much you make. It's about how much of what you make actually stays yours. And that number is shockingly dependent on a single variable most people treat as fixed: where you are. This is geographic arbitrage, and it isn't a digital nomad fantasy or a tax evasion scheme. It's a fundamental feature of how wealth actually accumulates, one that most people never consciously engage with because they're too busy optimizing the wrong variables. Let's break down how the system actually works. Your income runs through a series of filters before it becomes wealth. Federal taxes, state taxes, local taxes, then cost of living, housing, transportation, food, everything. What lands in your net worth column isn't your salary, it's what survives all those filters. And here's the mechanism most people miss. Those filters vary enormously by geography, but the salary feeding into them often doesn't, especially now. In 2025, roughly 23% of American workers are performing their jobs remotely, at least part of the time. For knowledge workers, software engineers, financial analysts, marketers, consultants, writers, that number is significantly higher. What that means structurally is that an employer in a high-cost city is paying you a salary calibrated to that city's labor market, but you are no longer required to live in that city to receive it. That's a pricing inefficiency. And in systems thinking, pricing inefficiencies are opportunities. The San Francisco engineer earning $180,000 isn't keeping $180,000 after federal taxes and California's top marginal state income tax rate, which reaches 13.3%, the highest in the country, plus the cost of housing in one of the most expensive markets on earth. That person might have $25,000 to $30,000 actually available to build wealth each year, maybe less. Move that same income, that same job, to Boise. Suddenly, there's no California state income tax. Housing costs drop by more than half. The take-home income that was being absorbed by geography is now building equity, compounding in investment accounts, padding an emergency fund. One analysis put that delta at more than $50,000 per year in effective savings. That's the difference between a 33% savings rate and a 75% savings rate. And that gap doesn't just make retirement slightly more comfortable, it cuts the timeline to financial independence from over 20 years to under 10. You didn't get a raise. You rewrote the filters. Now, 9 U.S. states currently collect no state income tax on wages. Florida, Texas, Nevada, Wyoming, South Dakota, Tennessee, New Hampshire, Washington, and Alaska. That list matters because it creates a patchwork across the country where identical incomes produce dramatically different after-tax outcomes. Take a concrete number. A senior engineer with $200,000 in taxable income living in California owes approximately $17,000 to the state, on top of everything owed federally. Move to Austin, and that $17,000 disappears entirely. That's not a rounding error. That's a car. That's a down payment in some markets. That's 3 years of maxed out IRA contributions. Gone. Because of a mailing address. There's a textbook example of this playing out right now along the Oregon-Washington border. Residents of Vancouver, Washington can commute into Portland, Oregon to work. And because Washington has no state income tax and Oregon has one of the higher ones in the country, those workers are capturing Oregon-caliber wages while being taxed at Washington rates. They're not gaming the system, they're just living on the correct side of a river. That's the 50-mile version of this strategy. You don't have to move across the country. Sometimes the arbitrage opportunity is the suburb 45 minutes away, across a state line, that nobody's treating as a financial instrument. But geographic arbitrage isn't just a tax story. That framing actually undersells it. The deeper mechanism is the relationship between your income's origin and your cost of living's origin. Those two numbers are increasingly decoupled, and that decoupling is the actual unlock. In a traditional economy, your income originated in the same geography where you spent it. You worked in New York, you paid New York prices, the system was self-consistent. But when your income originates in a high-value labor market and your expenses originate somewhere cheaper, you're running a structural arbitrage that compounds over time. Think of it like playing a game with regional price variations. The merchant in the capital city pays premium prices. But if you can source your goods from the outer provinces and sell them into the capital market, you're capturing the spread on every transaction. Geographic arbitrage works the same way, except the goods are your labor, and the spread is the gap between what a high-cost market values your skills at and what it costs to live somewhere else. What makes this more powerful than most people realize is the compounding effect. We tend to think about this in annual terms. You save $30,000 more per year, great, but that's not the right lens. If you're investing that $30,000 additional savings each year at a 7% average return, over 10 years, that's not $300,000. It's closer to $415,000. Over 20 years, it's nearly $1 million. The geographic decision you make at 30 doesn't just affect your 30-year-old finances, it affects what you're working with at 50 and 60, compounding the entire way. You're not saving money, you're repricing your future. Now let's talk about the business version of this, because it operates through a slightly different mechanism and the numbers get even more aggressive. If you're a business owner, freelancer, or anyone with flexibility over where your entity is incorporated or registered, the geography of your business structure carries its own set of financial variables, separate from where you personally live. States compete for business registration for the same reason they compete for residence: tax revenue, economic activity, prestige. Wyoming, Nevada, and Delaware have become dominant in this space, not because they have the best business climates in an operational sense, but because they've designed their legal and tax structures to be attractive to entities that don't need to be physically present to be registered there. Wyoming, in particular, has emerged as a preferred state for LLCs held by high net worth individuals, specifically because it imposes no corporate income tax, no personal income tax, and has strong asset protection laws. It's not an accident. Wyoming is running an explicit arbitrage against California and New York, offering the legal infrastructure without the fiscal drag. And businesses are responding. Data on interstate migration consistently shows that of the 25 highest-ranked states on the Tax Foundation's State Tax Competitiveness Index, 20 experienced net inbound migration in 2024, while of the 25 lowest-ranked states, 17 experienced net outbound migration. People and businesses are voting with their feet, and they have been for years. The important distinction here is legality and genuine domicile. Moving your body to a state for the sole purpose of claiming tax residency while actually living somewhere else is the kind of thing that invites audits and legal headaches. California, in particular, has aggressive residency audit programs and will pursue former residents who they believe never actually left. The arbitrage is real, but it requires an actual change in how and where you live and work. The play here isn't clever accounting, it's genuine structural relocation, and the honest version of it is still extraordinarily powerful. Here's where the counterintuitive piece lives, because geographic arbitrage has a hidden cost that most of the FIRE community and the move to a tax-free state crowd dramatically underweights. The states with no income tax aren't running charity operations. Revenue has to come from somewhere. New Hampshire, for example, has no tax on earned wages, but property taxes are among the highest in the nation, and overall costs run roughly 12 to 15% above the national average, significantly offsetting the income tax benefit for homeowners. Alaska has no income tax and actually distributes annual dividends to residents, but the cost of goods, groceries, and utilities makes it one of the most expensive states to actually live in. Florida's population has exploded partly on the no-income tax narrative, and the result has been housing price inflation that has materially eroded the cost of living advantage for anyone who didn't buy before 2020. This is what happens when enough players find the same exploit. The developers patch it. The arbitrage compresses. That's not cynicism. That's how markets work. The actual optimization isn't moved to a no-income tax state. It's a multivariable calculation: income tax, property tax, sales tax, housing costs, cost of goods, and trajectory. Where is this market heading? The best arbitrage opportunities tend to exist in places that haven't yet been fully discovered, which means you need to be running this analysis forward-looking, not based on last decade's migration patterns. The smart play is always ahead of the crowd. By the time the New York Times is writing trend pieces about Boise, the Boise arbitrage is partially priced in. This is also why the business geography question is increasingly worth running separately from the personal geography question. You may choose to live somewhere that offers quality of life, proximity to family, a cultural environment you want, and separately structure your business affairs in the most tax-efficient legal framework available. Those are two distinct levers, and treating them as one decision is leaving information off the table. The people who truly optimize this system aren't just moving to Florida. They're thinking about it in layers. Where do I live? Where is my entity registered? Where does my income legally originate? And how do those layers interact? It's systems architecture applied to your personal financial life. If this kind of breakdown is what you come here for, the mechanics underneath the surface, the hidden variables that most people aren't tracking, then 8-bit economics is the channel worth subscribing to. Every week, we strip a financial system down to its core architecture. No hype, no predictions, no surface-level advice, just the underlying code. If this video changed the way you're thinking about something, hit like. Drop a comment with where you think the best underpriced geographic arbitrage is right now. That's a genuinely interesting data set, and I read the responses. Subscribe if you want the next one when it drops. By the time everyone sees it coming, the smart play is already over. So here's the uncomfortable math buried in all of this. Geographic arbitrage works, concretely, demonstrably, at a scale that dwarfs most investment strategies available to ordinary people. Restructuring your income-to-expense geography is arguably the highest leverage financial decision most remote-capable workers could make. But it requires treating your address as a financial instrument, which feels strange because we're conditioned to think of where we live as a lifestyle choice that sits outside the financial spreadsheet. The two engineers at the beginning of this video made the same career decisions, same company, same performance reviews, same market. 20 years from now, the gap between their net worth columns will be enormous. Not because one was smarter, not because one took more investment risk, but because one understood that in the current system, your zip code is a balance sheet entry. Whether you decide to move it or not is a personal calculation that involves factors well beyond the spreadsheet. But you should be making that decision with clear eyes about what it actually costs you to stay.